Member Crapo, members of the committee, I appreciate the opportunity to testify here this morning. The collapse of Lehman Brothers and AIG in September of 2008 highlighted the importance of regulatory reforms that go beyond trying to prevent individual financial institutions from failing. We need reforms that act to make our markets more resilient in the face of such failures, what engineers and risk managers call safe fail approaches to risk management. Well-capitalized and regulated central derivatives clearinghouses to track exposures, to net trades and to novate them, to collect proper margin on a timely basis, and to absorb default risk have historically provided the best example of successful safe-fail risk management in the derivatives industry. Encouraging a shift in derivatives trading from OTC markets without central clearing to organized government-regulated markets with central clearing is challenging, however, for two reasons. First, the dealers that dominate the OTC derivatives business have no incentive to accommodate such a shift. Dealers earn approximately $55 billion in annual revenues from bilateral OTC derivatives trading. Some of the largest can earn up to 16% of their revenues from such trading. It is natural that dealers should resist a movement in trading activity onto exchanges and clearinghouses. Where compelled by regulation to accommodate it, dealers can also be expected to take measures to control the structure of and limit direct access to the clearing operations. The use of measures such as unnecessarily high capital requirements in order to keep smaller competitors or buy-side institutions from participating directly as clearinghouse members are to be expected. Indeed, trading infrastructure providers organized as exclusive mutual societies of major banks or dealers have a long history of restricting market access. For example, in the foreign exchange markets, the bank-controlled CLS settlement system has long resisted initiatives by exchanges and other trading service providers to pre-net trades through a third-party clearing system prior to settlement. Such netting would significantly reduce FX trading costs for many market participants, but would also reduce the settlement revenues generated by CLS and reduce the trade intermediation profits of the largest FX dealing banks. There are therefore solid grounds for regulators to apply basic antitrust principles to the clearing and settlement businesses in order to ensure that market access is not being unduly restricted by membership or ownership limitations that cannot be justified on safety and soundness grounds. Second, some types of derivatives contracts do not lend themselves to centralized clearing as well as others. Customized contracts or contracts which are functionally equivalent to insurance contracts on rare events are examples. Since it can be difficult for policymakers or regulators to determine definitively whether given contracts, new types of which are being created all the time, are well suited for central clearing, it is appropriate to put in place certain basic trading regulations in the OTC markets that will serve both to make such trading less likely to produce another AIG disaster and to encourage the movement of trading in suitable products onto central clearinghouses. Two such measures would be to apply higher regulatory capital requirements for non-cleared trades in consequence of the higher counterparty risk implied by such trades, and to mandate trade registration and collateral management by a regulated third party, such as an exchange. In establishing the regulatory standards for the clearing of derivatives transactions, it is imperative for lawmakers and regulators to be fully conscious of the fact that the derivatives market is effectively international rather than national, and that it is exceptionally easy for market participants to change the legal domicile of their trading activities with a keystroke or a simple change of trading algorithm. In this regard, I would highlight two important areas of concern. First, the three major world authorities controlling the structure of the derivatives clearing business, the SEC, the CFTC, and the European Commission, each take a very different view of the matter. Historically, the SEC has applied what I would term the utility model to the industry, the CFTC has applied what I would term the silo model, and the European Commission has applied what I would term the spaghetti model. The SEC's utility model favors institutions operated outside the individual exchanges, in particular the DTC in the equities markets and the OTC in the options markets. This approach is generally performed well in terms of safety and soundness and in encouraging competition among exchanges. It performs poorly, however, in terms of encouraging innovation in clearing and settlement services. The CFTC silo model allows the individual exchanges to control their own clearinghouses. This approach has also performed well in terms of safety and soundness. The CFTC's model also encourages innovation in product development in a way in which the SEC's model does not. This is because CFTC-regulated futures exchanges can capture the benefits of product innovation in terms of generating trading volumes, whereas SEC-regulated options exchanges risk seeing trading volumes in new products migrate to other exchanges, all of which use clearing services provided by the OCC. On balance, I believe the CFTC's model is the more appropriate for the derivatives industry. The second point I would like to make regarding the global nature of the derivatives trading industry is that certain measures to curb speculative activity being debated here in Washington are likely to push trading activity off exchange, precisely the opposite of Congress's intent. For example, a so-called Tobin tax on futures transactions at the level being discussed last year, 2 basis points or 0.02%, would be equivalent to over 400 times the CME transaction fee on Eurodollar futures. Should go without saying that a tax this large relative to the current transaction fee on the underlying contract would push all of this activity into alternative jurisdictions. Likewise, commodity market position limits, if not harmonized with UK and other national authorities, will merely push such trading outside the CFTC's jurisdiction. There is already an active regulatory arbitrage on oil and natural gas futures between the CME's NYMEX exchange, which trades such contracts under CFTC regulation, and the Intercontinental Exchange, which trades such contracts under FSA regulation in London. In short, we must be extraordinarily cautious not to undermine Congress's worthy goal of bringing more derivatives trading under the purview of U.S.-regulated exchanges and clearinghouses by inadvertently providing major market participants incentives to do precisely the opposite. Thank you, Mr. Chairman.
Dr. Spencer.